Imagine you could see into the future and warn others of impending doom, but when you did, nobody believed you. How would you react to this? Well, such was the case with Cassandra, the daughter of the Trojan king Priam in Greek mythology, which is why Michael Burry chose to go by the name Cassandra BC as his handle on Twitter. But who is Michael Burry, and in what ways does he draw parallels to Cassandra? Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. Michael Burry is an American physician turned investor and hedge fund manager who is known for his successful bet against the US housing market in the mid 2000s. Burry started his career as a neurologist, but later switched to finance and founded his hedge fund Sion Capital in 2000. In 2005, he began to focus on the US housing market, which he believed was hedging for a major crash due to the rapid rise of subprime mortgages, or in other words, home loans that are made to borrowers who have poor credit scores or may not be able to qualify for a traditional mortgage due to a variety of factors such as low income or a history of late payments. He gained prominence in the financial world when he predicted the housing market crash of 2007-2008. He did this by analyzing the mortgage bonds that were being sold at the time and recognizing that they were backed by subprime mortgages which were very likely to default, meaning they were likely to fail. He bet against the housing market by buying credit default swaps, a type of financial instrument that pays out if the underlying mortgage bonds defaults. Burry faced significant challenges in convincing investors to follow his strategy, as many did not believe that the housing market was at a risk of collapsing, so much so that others accused him of being a fraud. His prediction, however, turned out to be correct, and Sion Capital profited greatly from the housing market crash. The fund's assets grew from $600 million to $2.7 billion and made a profit of over $700 million. This story got so big that Michael Lewis, a prominent author and financial journalist, wrote a book about it titled The Big Short. It later got adapted into a movie with the same name, starring Christian Bale as Michael Burry. These days, you can find Michael Burry on Twitter, tweeting something about the current financial conditions and then proceeding to delete the tweet. Fortunately, there's a Twitter account dedicated to capturing everything he's had to say, and I must say, he's had a lot to say. He's talked about meme stock during the GameStop craze, he predicted the fall of the crypto market, and has been commenting on what the effects of COVID and all the measures taken would be. He's even had Elon Musk call him a broken clock, but as the saying goes, even a broken clock is right twice a day. He recently came out with a one-word tweet, sell, which shows his lack of trust in the government and how their decisions are affecting what is happening in the markets. He did, however, take back his words when he tweeted in March saying, I was wrong to say sell, which he followed up with this chart, talking about how consistent people have been when it comes to buying the dip. I like the fact that he admitted to his mistake and pointed out to a strategy that can be effective when used correctly. There's a famous saying that says that the stock market is the only market where things go on sale and all the customers run out of the store. Think about it. What happens when things go on sale, especially on Black Friday? People flock to the stores to get their favorite items for a bargain. Some will even camp outside the store, waiting to be the first ones on the action when the store opens. But the opposite tends to apply when it comes to stocks and other investments. This is an indication of a problem with how most people think, which isn't the best approach when it comes to the world of investing. As mentioned in other videos, I believe in long-term value investing. This simply means that I believe in buying up stocks of good companies that are trading at fair value, that have great potential for growth and earnings in the future, then holding on to these for a long time in order to enjoy long-term gains. In the investment world, there's a commonly used phrase known as buying the dip. This refers to buying up stocks of a company whose share price has experienced some decline. This is done with the expectation that the price will eventually pick back up, thus making the investor some profit. Buying the dip is a very fascinating thing, as you can never really know if you are buying at the very bottom or not until later on when you've already taken action. Sometimes it happens that after you buy, the price goes down again. This is where an understanding of the company will be a great determining factor in what to do next. This means that buying up stock of a company, even when the share price has fallen, can be a good thing to do. This, of course, is true if the company whose stock is in question is a good company that is still doing well. This you would know because you would have done your homework. So after initially advising people to sell, Michael Burry had to admit that buying the dip has been very profitable for most people. He even provided proof of this with a chart that pretty much says that 2023 is the best time to buy the dip. This happens for different reasons. In 2020, a lot of companies took a bit of a hit to their share prices due to lockdowns caused by COVID. This caused the markets in general to fall. Once this ended, interest rates were dropped and a lot of money was printed in order to encourage more spending, which in turn would stimulate the economy. This presented a good opportunity for investors to buy up more stock at discount prices, which many did. As the economy started picking up, so did the markets, and those investors started seeing growth. Unfortunately, the printing of money and low interest rates ended up causing inflation to rise, and in response, government had to raise interest rates. This caused the markets to slow down again, especially with how rapidly the rates were being raised. Today, inflation hasn't quite came back down enough for interest rates to be decreased. In fact, there's still fear of another rate hike in the future. For those who are thinking for the short term, this is a very scary thought. And of course, this would impact a lot of people negatively. But for the long-term investor, this could be a great opportunity for a good investment. One of the biggest problems we see with a lot of investors, especially beginners, is that they hear that the markets are going down and instead of buying, they do one of two things. They either panic and sell, as Michael Burry had previously advised, or they stand on the sidelines waiting for the market to crash before they start buying. Both approaches can be very ineffective and can lead to losses, regret, or both. By selling what you already have while it's in the red, you are locking in your losses. This goes against Warren Buffett's two rules. The first rule of an investment is don't lose money. The second rule of investment is don't forget the first rule. By waiting for the market to crash, you are making the assumption that you will know when the time is right, when the bottom has finally been reached. But what are the chances that you'll get it right? Concerning time in the markets, Peter Lynch had this to say. Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. A market correction is simply a term used to describe when the markets go down rapidly in a short space of time. So if buying the dip is profitable, but timing the market is dangerous, what should you do? The solution is dollar cost averaging. This simply means buying stocks consistently over set intervals. By so doing, you are more likely to buy at times when the price is on the rise, but you'll also buy at times when the markets are on the decline. This means that in the end, you'll get the average of those movements. This is a more reliable approach that will guarantee good returns. You can always supplement this by buying whenever there's a decline over a certain percentage, which you will have to determine for yourself. For me, it's usually whenever the price goes below my average purchase price for that particular stock. So dollar cost average into the markets, and just like that, you'll put yourself in a good position not to lose money. So why listen to Michael Burry then? Well, as you can tell, he's very good at giving predictions about the short term, which you can use to build up your portfolio for the long term. He is, after all, the self-proclaimed Cassandra. If you go and look at his track record, you will see that he has been able to make money in 2001 when the dot-com crash happened, and in 2008 when the housing market crash happened. Those who follow his investments will know that he's capable of buying up stock in one quarter and selling it in the next one. This is because he is a very calculated person and very smart too. You don't have to try and be like him. By taking the simple approach of buying good companies at fair value and holding them for the long term, you can make some great returns. In conclusion, it is not bad to listen to what other people have to say, especially Michael Burry, but you need to do your own due diligence before acting on whatever he or anyone else says. Peter Lynch does a great job at explaining this point, and so I'll let him do that.
This is the single biggest principle, and it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it.
That clip from Peter Lynch is from 1994, but is so full of gold nuggets on investing that it's still relevant to this day. I liked it so much that I've linked the full video in the description for you to watch, so go check it out. So what do you think of Michael Burry? Do you also think he's a broken clock? Let me know in the comment section below. Also, let me know what your biggest takeaway from this video is. If you found value in this video, then show some love by leaving a like and sharing the video with a friend. While you're at it, be sure to subscribe if you haven't done so already, and click on the notification bell so you stay up to date with all the latest content. Thanks for watching. Hope to see you on the next one, but until then, stay invested.